Here we are. The month of October has we've just turned the page to November. And we're going to take a look back at October. Good morning, Mike.
Good morning, Will.
How was your October?
Oh, it was good.
Yeah.
Yeah.
You did some trick-or-treating, I know, yesterday. Gave out some candy.
Pretty hardcore trick-or-treating with a 2-year-old and a 4-year-old. A lot of fun.
That's awesome. October's quite a month. Just first off, just give hats off to the Michigan State Spartans for beating Michigan yesterday. Very cool. And as we turn the page, we're going to look back at October, a very transformative month compared to September. If you remember, September wasn't such a great month. But let's start off looking at the board and go through the returns for October.
Yeah, we'll start off here looking at returns of various asset classes that are generally included in a diversified portfolio. And we'll start in the upper left of the grid. So those are the returns here just for the month of October. The S&P up 7% for the month. And Will, as you suggested, you recall September down, near 5% at one point for the S&P 500. September was the worst month for the index since March 2020. And, of course, the dip was bought and the S&P up 7%. That's now the best month since November 2020, which you may recall was the vaccine month. The month that we got the news was far better than expected on initial trials of Pfizer and Moderna vaccines. So a very strong rally in the US, investors buying the dip on the S&P 500, small caps getting a bit as well, up over 4%. Foreign equities posting some returns as well, primarily from the more growth-oriented stocks within the index. So foreign developed markets up 2.5%. They're now up double digits year to date. And then the dip was even bought in China. So the MSCI EM index up almost 1%. Importantly, the MSCI China index, which is the largest country weight within the emerging markets index, was up over 3%. That was its best month since January of this year. So finally seeing some evidence of dip buying in China as well. And while equities were rallying, bonds were selling off. So interest rates rising, particularly at sort of the belly of the Treasury yield curve. Think maturities from 2 to 10 years. Interest rates rising there. When interest rates rise, bond prices fall. And interest rates were rising primarily due to that more hawkish shift that we heard from the Fed at the end of September and rising inflation expectations throughout the month. So if you think what were the winners in the bond market, it was actually TIPS, Treasury Inflation Protected Securities, which we don't show here on the board, but they were the best performer in the bond market. And then the last piece to look at month to date are the alternatives, so inflation sensitive assets, things like global real estate investment trusts or global REITs, those performing very well, up over 5%. And then commodities just continuing to post strong gains. The gains were pretty broad-based: precious metals, industrial metals, agriculture, just commodities continuing to perform very well.
It was quite a month. A lot of headlines that came across and that we want to focus on. But let's talk first about what we think are probably the four big headlines. So what's going on with the virus, the first print for Q3 GDP, and then we'll look at corporate earnings and the supply chain disruptions. Let's start off with the virus. What's the latest and greatest there?
Yeah, COVID-19 cases are falling, not just in the US, as we show here, sort of that light gray line. You can see case counts falling dramatically, hospitalizations falling, and deaths leveling out and starting to fall. So this is great news. We talked about late summer how Delta variant was going to result in increased immunity somehow, either through vaccine mandates or through natural immunity because of how quickly the Delta variant spreads, especially as we reopen schools and kids start going back to school full-time in person. And it appears that higher immunity has occurred and is showing up in the data. So if you look now, 97% of the US population over the age of 65 has at least one dose of the vaccine, a pretty substantial improvement from where we were in the spring. And this is great because it's not just happening in the US, it is happening globally. And this really helps out, these headlines that you just spoke to, they're all sort of interconnected. And as this COVID-19 situation improves globally, that's going to improve things like the economic growth outlook, the corporate earnings outlook, and hopefully help heal supply chains. So this is all great news at a great time, right in time for the holidays, where people hopefully are going to be getting together and spending more money on services. So
Yeah, and we're seeing it in the high frequency data. Although the headlines of the airline cancellations are sort of big news, we've actually seen bookings and TSA throughput, continuing to accelerate, almost hitting the 2019 levels on daily basis. So all good news. Planned vacations are up, and a lot of service spending is continuing to be fueled by the decrease in these case counts. So this is really good, I think, as we move through the end of the year and into Q1, a really good thing for us to continue to monitor, and very supportive of equity markets going forward.
yeah.
So let's turn to GDP. Our first look at GDP for Q3, and maybe walk us through here how we break this down.
Yeah, it's the GDP prints are getting more and more complicated to analyze because of how dramatic the year-over-year comparisons are because of the COVID-19 recession and then the stimulus fueled recovery. So we've taken the components, the broad components of the GDP report, and broken them down to look at them individually. So we're looking across components here, and we're also looking across two different time periods. The dark blue bars are the annualized change since Q4 2019. So you can see how we're doing, stripping out the impact of the pandemic. And then the green bars are just this most recent report, the Q3 advance estimate that just came out. So we'll start this thing left to right. First, just looking at the aggregate number. So since Q4 2019, US real GDP is up 0.8% annualized. So the economy has fully recovered from the pandemic. That actually happened last quarter. So any growth now is growth in excess of pre-pandemic levels. And then that Q3 advance estimate came in at 2%, which is okay, but far slower than the GDP reports we had during Q2 and Q1. This is actually the slowest GDP report of the recovery period. So a lot of negative headlines have been written about it. And in our view, if you look under the hood, it's actually a pretty bullish setup. It's a bit of a reset. It's sort of exactly what the economy needed is what happened in Q3.
And it's sort of correlated with the case counts we just looked at on the previous chart, where they sort of peaked in September there.
Yeah, definitely. And you can start to see how COVID has impacted buying habits as we move through the components here. So now we move just one over to the right. You have spending on goods and services. Those are, you'll hear personal consumption expenditures, or PCE. That's basically what it breaks down to. So since Q4 2019, the goods purchases are up 8.7% annualized, which we know, right? Everybody's staying at home buying stuff. They all got money. Personal incomes are at record highs. You can't go out and spend on services, so people have just been buying stuff. Versus since Q4 2019, spending on services is down still. Service expenditures have not recovered, down 0.9% annualized. Now, Q3 2021 was one of the biggest changes from this trend that we've seen recently. So you see goods expenditures during Q3 down aggressively, down 9.2%. Think about auto sales, right? That's a classic example. Spending on goods down pretty significantly quarter over quarter. And spending of services almost offset, which is great. So services up 7.9% in Q3. So this is showing, we all know that we need a shift from buying goods to buying services in order for the economy to continue to recover, and in order to give supply chain some breathing room. If everybody just stopped ordering stuff for a while and instead went out to dinner, it would do a lot to heal supply chains. And in Q3, we saw that shift start to happen, which in our view, I mean, you could point at the down 9.2% in goods expenditures and say, oh, well, this is awful. This is doomsday. The economy's going to be, we're going to approach recession. Or you can look at the spending and services and say, this is exactly what we needed. It just happened very quickly.
Yeah, it's a lot of those goods purchases were in a result of lack of demand side. It was lack of supply side. There weren't enough cars to buy. There aren't enough durable goods to buy right now. So as you said, as supply chains heal, we think that we're still going to see robust spending on goods as well.
Exactly. Yep. And if we the next set of bars are domestic private investment. So non-residential investment has been pretty stable, but you see the big shift in residential, where residential investment since Q4 2019 up 7.7% annualized. Huge gains. We know everything that's been going on in the housing market, and then once you buy a house, you have to spend on things for the house, right? And you saw in Q3 a big pullback there. So we know that home sales slowing somewhat, just now starting to pick back up. We know the housing market is very expensive and very competitive. So seeing a little bit of a break there, residential. But just because you have one quarter where residential investment falls off, it does not mean that there still isn't underlying demand for housing. It just means that perhaps that demand was foregone during Q3 because prices are high, and maybe it will happen in the future. That demand will be realized in the future.
And inventory is low right now.
Exactly.
So it's a big proponent of that also.
Exactly. Yeah, you can see the impact of low inventories and tight supply chains in those big negative green bars. Goods down and residential investment down. And then the if we go all the way to the right, we'll focus on these change or net items. So 2 line items in the GDP report that aren't like the others. The first we'll look at is the change in inventories. So, and I want to relate this change in inventories directly to the change in goods expenditures. Since Q4 2019, we know spending on goods has increased 8.7% annualized. But on average, we haven't built any inventories. We've just been burning through inventory that we had since Q4 2019. Now, changes in inventories or inventory rebuilds, we are in desperate need of an inventory rebuild, and inventory rebuilds directly add to GDP. They flow right through to the GDP calculation. So finally in Q3, we got a bit of an inventory rebuild. This is our first rebuild since mid 2020. We'd just been drawing inventory down because supply chains we needed time to heal supply chain issues. Finally, we got an inventory rebuild. If you want to paint this GDP picture very negatively, you would say, wow, in Q3 2021, real GDP was only up 2%. And if you take out the inventory rebuild, it was negative.
Yeah.
You could say that. Yeah. Or you could say, thank God we finally got an inventory rebuild. Now this sets us up for future quarters to be able to buy goods again because people actually have them in stock. And thank God we got this shift from goods to services, right? So other parts of the economy that are in more desperate need of healing have an opportunity to start to heal and get some revenue.
Yeah. So what does a report like this, I mean, you could develop your own narrative as you just suggested off of these numbers. What does this really suggest though for Q4 GDP?
Yeah, in our view, this is a pretty bullish setup because GDP is measured quarter over quarter. And we just got a 2% print. So we grew at 2% during Q3, despite all the supply chain problems, despite the Delta variant, despite more lockdowns. All of this, we still grew at 2%, which is nice, but it's also very beatable because there are elements of this report that are a great setup for Q4 and even Q1. People are going out and spending more on services. They've taken a break from goods, which allowed companies to rebuild inventories, which sets up for more goods purchases in the future. So we think this sets up for something like a 5% plus print in Q4, which is great.
Yeah, very bullish for sure. All right, let's move on to sort of the next obvious topic would be corporate earnings and how this is looking currently and what we project going forward.
Yeah. And corporate earnings, I mean, you want to see a chart where things like the Delta variant, supply chain issues, and labor shortages, you hear about them all the time, but they ultimately haven't mattered. Look at the corporate earnings chart. I mean, companies have just been making record amounts of money. So once again, the corporate earnings situation, the year over year and the quarter over quarter comparisons are heavily influenced by the COVID-19 pandemic and the difference in base effects. So this chart, once again, is a busy chart. The bars are quarterly operating earnings per share for the S&P 500. And you see we get to Q3 21, which is the current reporting period, 56% of companies have reported. So that $52 in quarterly earnings is if the rest of the companies that report come in line with expectations. by the way, they're beating on average by 10%. So they're probably going to do better than that. So that 52 is probably going to go up. Then those light blue bars are bottom-up consensus analyst estimates going forward. Those have been going up, and companies have still been beating them. So that's what you're looking at first. And you can see as you trace these bars, the big slowdown in Q2 2020. You can see that it looks like quarterly earnings peaked in Q2 2021 at about $53 in quarterly earnings. And now we're just plateauing at this awesome level in Q3 and Q4 and Q1 2022, assuming companies don't beat, which
Right.
they most likely will. They normally do.
Yeah.
And then what you hear quoted most often is the year-over-year change in annual earnings. So that's the line with the diamonds. And here we're looking at, in Q4 20, companies, S&P 500 companies in aggregate reported $143 in annual earnings. And it's looking like Q3, we're going to come in at 196. So that's about 37% year-over-year growth. That's absolutely lights out. Yeah. And, there is some effect from the pandemic fading, or being a very low starting point. So very easy comps. But these comps are way harder than the comps were 2 quarters ago, right? Two quarters ago were peak easy comps, if you will. And everybody was making the call in Q2 and Q1 of this year that, okay, we're at peak growth. We're at peak earnings growth. And we're not, clearly. I mean, now they're saying this quarter is peak earnings growth. So companies keep beating by record margins, record percentage of companies reporting beating margins. And, you draw out those annual earnings estimates going forward, and it's just very conducive to, maintaining something like TINA. There is no alternative. I mean, this is a great tailwind for equities.
So maybe the biggest risk is not being long enough in equities.
Perhaps you could definitely say that.
Right.
Yeah. Right. And, there are certainly some high profile misses. There are companies that are coming out and giving negative guidance.
Yeah.
And
Apple.
You're hearing a lot. Yeah, exactly. Like Apple, hearing a lot of managements complaining about the same stuff: supply chain issues, labor shortages, chip shortages, so on and so forth. But it's clear that you should view that as, wow, if those things weren't issues, these numbers would have just been better. To think companies are delivering these results sort of with one hand tied behind their back just speaks to what we've been talking about for so long, which was a record amount of money was created in 2020. And first that flowed through to personal incomes, and now it's in the process of flowing through to corporate earnings. And it was far more money than anybody had ever seen. And so analysts are really struggling to price in the magnitude of that money and how it actually flows into earnings. They cannot keep up. Yeah. They cannot raise estimates fast enough. Companies just keep beating.
Right. This is a great way to illustrate the trend here and how to think about the risks. The risks are really to the upside for at least the next 3 or 4 months. So let's talk about supply chains, since you mentioned that, because that's an interesting topic to dive into, and there's a lot on the news about supply chains, and it's becoming, I think, the most, next to inflation, the most worried thing for consumers. So let's pull up our graph here on the peak disruption.
Yeah, and try to simplify the whole narrative a little bit. Broadly speaking, the things we hear that are impacting companies, most of them fall into one of these 3 buckets. So the first is labor shortages. We've talked about this ad nauseum. The second is port congestion or shipping issues. Big container ships just stranded off the port of LA, just waiting for a berth, wreaking havoc. And then even if they were to get a berth, there's nobody there to unload.
Yeah.
And then even if there was someone there to unload, there's no one there to drive the goods to the warehouse. And even if they could, there's nobody working at the warehouse, right? So it's just massive issues. And then the final thing is chip shortages. Chips are in everything. The number of chips in an automobile has risen almost exponentially over the past 10 years. So everybody needs chips. So these are the big items. And we're going to be living with these problems for quite a while. Mm-hmm. But we think if you dive into each one of these items and think, what are the factors that are impacting them? There's reason to believe that over the next 3, 6, 12 months, they probably won't get resolved, but they may stop getting worse and start getting better, is the hope.
Right.
And once again, going back to companies delivering these results with one hand behind their back, maybe one of those hands gets loosened up a little bit and they can start making as much money as they potentially could.
Like you said, if all these things weren't problems now, we'd probably have much higher corporate earnings and higher GDP. So as we think we've hit the peaks in all these, super supportive going into next year. So
exactly. The news cycle calls the peak, right? Markets look for improvement.
Yep.
And I think that's probably where we're at.